Hello guys, and welcome back to a new video. In this one, I'm going to show you how to spot high probability liquidity sweeps. So basically, price when it runs an old high or an old low, it will either keep going up or down in the original direction, right? Continuing in the original direction, or it can reverse. So in this video, I'm going to share with you 5 factors or 5 conditions when you see on the chart price will likely to reverse after running that swing. All right, so the things that I'm going to explain in this video, you can use it as a high win rate strategy, all right, based only on sweeps and based only on the 5 conditions that I'm going to show you, or you can incorporate the things that I'm going to talk about in your existing strategy, and it will make it more efficient and it will increase its win rate. All right, so knowing when price is going to reverse is really important, and it will help you a lot in your trading. All right, so without any further introductions, let's just get started. So again, what is a liquidity sweep? Basically, price runs an old high or an old low. For example, you have an old high here, price was doing its thing here, and then price revisiting that high. Again, you have 2 choices here. Price will either keep going up or it will reverse. And a lot of traders are basing their strategy on the sweep right here. And a lot of times they get stopped out. So in this video, we're going to talk about the factors that when you see here, price is likely to reverse. So let's start with the first one. And the first factor is that price or the sweep, right? It needs to happen inside the zone. What is a zone? A zone, for me, it is a swing point. For you, it can be an order block or a fair value gap, all right? Although I don't use fair value gaps anymore, but you can still use fair value gaps as a zone. For example, let's say that price is trading higher like this, and then we have a market structure shift here. So basically, from this low to this high, this is a zone for me. For you, it can be from this high to this low, and you can run your fibs from this high of this low, and this will become your zone. Or also you can consider this as an order block. So price now retrace back inside the zone, and when you see the sweep happens here inside the zone, you can assume that this is a high probability sweep and price will reverse to the downside. Why? Because the zone is likely to push price to the downside in the right conditions or in the right context. So you have that. So a sweep inside this, a sweep of a certain high inside the zone, that's a high probability sweep on liquidity, and price will likely to reverse after running that high. All right, we are going with a bearish example for this. A bullish example, you can reverse everything. All right, simple. The second factor, of course, price takes an old swing. What do you mean by that? Basically, we have a zone right here, right? From this low to this high, this is a zone. Price returns back into here. So this is the retracement. It starts going lower, and then one more time, trading all the way to here, sweeping this high, and then continue lower. This is a real move, all right? So what happened here? We have a top of the zone, right? Price continue lower. And as you can see, this is a shallow top or a shallow retracement inside this higher time frame zone. And then one more time sweeping this, right, inside the zone. This is a high probability sweep. So this is different than a fresh swing. For example, price can have a sweep here inside this. So if you go to the lower time frames or maybe the same time frame, you will see maybe something like this. And we are talking about this swing, not this swing right here. So one more time, sweeping these 2 highs and then continue lower. This is a new swing. But taking an old swing to the left, this is high probability, all right? Not saying that this doesn't work, but taking an old swing to the left, especially if it's a shallow top, just like this, and then we have a deeper mitigation, that's really high probable. And I'm sure a lot of you have noticed this pattern. You have this market structure shift, price did the first stop, started going lower, and maybe you want to chase price, and then you will see this one more move, one more leg to the upside, right? And a lot of you will get stopped out, a break even maybe, and then continuing lower. This happens every single time. The third factor or the third condition is closing back inside the range. What do we mean by that? So suppose that this is an old high, right? This is an old high. An old high is a formation of 3 candle. This is basic stuff. A sweep is something like this. Sweep and closing back inside the range is something like this. Suppose that we have an upper close candle and we have a wick right here. So this wick, right, this wick swept this high and then price closed back inside the range. So we don't have a body closure. A body closure is important and you need to pay attention to this stuff. A body closure, right, like this one, is not the same as a wick closure like this one. This is a wick closure. A wick closure can indicate that this is only a sweep. Price couldn't close above this high right here. We only have a wick, right? So we have a rejection. This can also indicate that this is a high probability sweep and price will reverse, of course, paired up with other factors that we have mentioned. As you can see that this is a green candle. Sometimes you will have something like this. So as you can see, we have a huge or strong rejection to the downside and the candle closed bearish. This is better than the previous example or the previous scenario. As you can see, we have a strong rejection to the downside, all right? So in terms of probabilities, this is higher, right? This is better. The fourth factor or the fourth condition is the CSS confirmation or the candle structure shift confirmation. What is this? Basically, if you are a dtfx student, this is easy. This is the candle that swept the high, right? This is the candle or the candle that created this high right here. A CSS is something like this. Something like this, right? We have a body closure, we have a break of structure inside the candles itself, all right? So as you can see, this bearish candle closed below the low of the candle that created the high. So in terms of open, high, low, and close, or open, low, high, and close, right? Price opened here. This candle opened from this level right here. It created the low and then expanded to the upside, creating the high right here. So this is the low that created the high, all right? And we have a body closure below. So this is just like the traditional market structure shift. So this is a CSS confirmation. We have the sweep closing back inside the range, and then here we have the CSS. So this is the previous range from this low to this high, and what you want is you want to take your entry from somewhere around here, all right, the pullback. So this confirms that this is just a sweep and price shifted in terms of market structure. And now let's move on to the fifth and final factor. The final factor is a target. We need a target, all right? That is the reason of why price should reverse. This is very important. Just because it is the last one doesn't mean that it doesn't matter. This is very, very important. We need a target. Otherwise, we are just shooting in the air. So a target can be either a zone, or it can be an unmitigated zone, or it can be a low resistance liquidity like smooth edges. For example, suppose we have this. So as you can see, we have that market structure shift. We have the zone, we have the sweep here, right? And do we have a target? We have this unmitigated zone, so price didn't tap into it. So as you can see, price didn't tap into it. This is unmitigated zone. We also have these smooth edges, right? So this serves as trendline liquidity, and price likes to run these three or these edges right here. So we have liquidity, just above an unmitigated zone. Of course, having only one of these two is okay, all right? But having the two is really, really high probability, and you have something to target right here. And this also can be another sweep on liquidity, all right? So price taps into a zone, inside the zone, and we took an alt swings, which is these three swings right here, close back inside the range. I don't know, maybe we have that, maybe we don't, all right? So you don't need to have all these 5 factors for the sweep to be valid, but of course having all of them, or maybe most of them, is really high probability, all right? And here maybe we have the CSS confirmation, and for a target, maybe something on the upside, right? So this is how you spot high probability sweeps. So I believe that this is the end of this video. In the next video, I'm going to show you examples, trade examples, and backtesting examples, so you can really understand this concept better. I don't want to make this video long, right? I know that the attention rate is not I don't want to make the video long because I noticed that a small percentage of the viewers can't make it till the end. I know that this is because of how social media works in these days, all right? A lot of reels, short videos are really lowering the attention rate for people, right? This is why they can't make it till the end. So I decided to make my videos short, right? And divide them into parts. So see you in the next video. If you have any questions, please DM me on my Twitter account or leave a comment down below and I will answer you as soon as I can. Now happy trading and good luck.